Welcome back. You're watching Stock Watch this week, and joining me to unpack your stock-related questions this afternoon is Nader from Benguela Global Fund Managers. Do start sending your questions via email to stockwatch@bdtv.co.za or via SMS on 41392 or on X at Business Day TV using the hashtag StockWatch. Thank you so much for your time, Grant. I'm not sure if markets are quite clear on, or if you are clear on the direction of sentiment in the markets, because it's really just been quite a volatile week where we even saw the rebound that we saw yesterday on the JSE not being able to be extended to today, even now with the resources counters going back into the red. Is it at this point still investors trying to figure out what the Fed is going to do with interest rates and not being quite sure yet?
Yes, there's actually a lot of cross currents at the moment, and I think if I had to try and put it into bigger themes or categories, you have seen this specifically. Let's talk resources. So there's been this quite a strong bounce across the space: PGMs, gold, general miners, etc. And I think what's happening there is as the prospects for rate cuts sort of firm up a little bit, that's supportive of commodities. As inflation itself actually remains a little bit sticky, that is potentially supportive of commodities that do well in a higher inflation environment. And then you also have a lot of supply chain and disruption risk around with all the goings on, whether it's in the Middle East, specifically linking to oil. We still have the Russia-Ukraine. So there's quite a lot of uncertainties around, and those are provided, around the potential for disruption. And China also had some good economic data that came out this weekend. As we know, they are by far the biggest consumer of commodities. So if you put all those factors together, there's been an improving sentiment toward the commodities in general. Other than iron ore, copper's had a strong recovery. PGMs, gold has actually got different things playing out. But broadly speaking, an improved sentiment toward commodities, and you've seen that come through nicely in the market. Against that, though, we've seen a lot of the SA space, retail, banking, financials. Those have all been coming under quite a bit of pressure. And finally, yesterday we saw sort of a bottoming out, some bottom picking in some of those stocks, and that was somewhat encouraging to see, as they were looking quite heavy on the downside. So a lot of noise in the system, a lot of uncertainty, predominantly inflation and interest rate and geopolitics related.
Well, talking about bottoming out and also the resources complex, I'm not sure how closely you watch Merafe, but there is a question here on your thoughts on Merafe, considering that we are at the bottom of the commodity cycle. Are we at the bottom? Can we confirm, or does today prove that we might not be?
Look, there's never a line in the sand at the time where you know we're at the bottom. It's always something you see when you look backwards. Morfi, from what I understand, and I don't know the company that well, is predominantly chrome. They're largely in chrome, and I do see that there's definitely a lot more de-risk. Well, let's say there's a lot less risk in the prices, given where commodities are. So whether it's the bottom or not, I can't say. What I can say is you're better buying it now than if you bought it a year ago. Because a lot of metals have priced in this, that overreacted in 2022, and then into 2023 we saw that sharp pullback, and now you're finding this bottoming out, the stabilization. It's a much better time to be looking at the space. To be honest, if you don't know and you're not sure, don't put all your money in at once. Maybe buy over a period of time, just to minimize the sort of timing risk if getting the bottom of the cycle is vital to your investment case.
Yeah, there's a question here. What is the gold direction today? From actually what I saw, the gold counters were actually down today, and actually but I mean, gold still seems to be on quite a good footing, the actual gold price. Just your analysis on what's been happening with gold, and also, how beneficial this is to the miners.
Yeah, I mean, first of all, gold is at all-time highs. And I think it's very beneficial to the miners. The miners are highly geared. So for every $1 move in gold, it's a bigger than a equivalent percentage increase in earnings to the miners. So in terms of getting upside gearing to the gold price, you're going to get more action in the miners than in the gold itself. But that happens on the downside as well. So that's just something to bear in mind.
Yeah,
In terms
indeed.
of why the price is here, I think there's a few factors at play. And there's the obvious traditional one, which is around the geopolitical risk. The rising tension in the Middle East it's really a hotbed. The Russia-Ukraine war, it's not as reported on as often, but it's not gone away. It's there. It's very much there. The risk of an escalation is very much there. So that is underlying the psychology of where the world is. Plus, we know there's a big like bifurcation in the world. The geopolitics, people are trying to move away. There's two camps. There's the US and its allies, and then there's China and the BRICS,
Yeah.
the Russia-India cohort. And that there's been a significant amount of central bank buying as some of these countries are trying to like limit their dependence on the dollar. It doesn't suit them if the US has control over their bank accounts, over SWIFT payments, etc., and they get into some form of conflict, and they can just turn off the taps and they have no money
Yeah.
supply. So there's a lot of central bank buying as they're building alternate reserves. China's been the biggest. We've seen it across a number of countries, the BRICS as well. That's been the biggest driver. It hasn't been retail investors. ETF holdings have actually been going down in the context of this rising price. So that's an interesting point to note as well. And I think it tells you the story of where the buying's coming from.
Yeah, indeed. You spoke earlier on about that the financials, the banks were actually under some pressure. There's a question here specifically for Capitec. Is Capitec a buy at current levels to keep over the short to medium term? Has Capitec also just been moving in the general direction of the broader banking sector?
So actually, of late, Capitec's been diverging. They've
Yeah.
actually been quite strong. They're as close to the highest they've been in over a year relative to some of the other banks which have had a decent pullback. And and I think Capitec it's a different animal to the other banks. The other banks are generally much deeper value, high dividend, a stable play into the SA economy. Capitec's going to give you a bit more risk, but you're getting a much better growth profile, a much more innovative and dynamic management team with growth opportunities, but it does come with higher risk. As to whether it's a buy at current levels, it is the most expensive it's been in the past year. So be that as it may, I think it's a good company to hold long term. In the short term, it's already had a decent run. I would probably be hesitant to put too much of my investment into it at current levels. I'd probably hope to see better levels over the next couple of months and add to it. But if you have nothing and you want some, make a start by all means, and then perhaps hopefully you get a chance to nibble a bit lower down as well.
Yeah, that's the thing, because I was gonna say, I mean, in I think the last, how long have I been doing financial journalism? Over the last 3.5 years, I have not heard anybody saying that Capitec is cheap. And
Exactly.
yeah,
Exactly.
and I wonder if you're constantly at a point where any time it actually goes down, then you go in, because it will just never be cheap.
Yeah. So even when it goes down, it's still not cheap. So the
Yeah.
point is you need to decide, do you want to own a high growth quality company that is trading at a higher valuation in your portfolio with a long-term view? And the view matters the most, because over the longer term, that entry valuation matters less. It matters a lot more in the short term. So if you're building a core portfolio as a DIY investor, and you want this kind of company in your portfolio, you need to buy some, but understand that your time horizon can't be too short term. Just buy a little bit and then buy some more and then buy some more, and be prepared to hold it for the long term, and I think you'll be fine.
Well, talking about buying, capital appreciation. Of course, they own some of the point of sale payment systems. Your insight into capital appreciation and their role in the payment sector. Is this not one of the growth stories? Why is the share price heading lower? I feel like the story doesn't necessarily go with the share price sometimes. Sometimes there is a divergence. The company can be quite different from the share price. Your take on capital appreciation, Grant?
So I'm not incredibly close to it. I do know enough. I know they are point of sales. It's a large part of their business. And they're also a software business as well. They have payment software and some other software that I know of.
Yeah.
I believe it's a good business with good management. I think there's a healthy cash balance in the company. I don't think doesn't look to me like a high risk purchase. It looks like it's offering reasonable value. What I will say is the point of sales component or business is highly competitive. You've got constant new entrants into the market and constant disruption.
Yeah.
And so you do run the risk that their margins are going to get compressed in that space with competition, or that sales get eaten by competitors. You think you've got Yoko, you've got
Yeah.
you know, these payment wallets now. You know, Apple wallets don't even, you know, so there's you know, what are those little scanning codes? There's any number of, you know,
SnapScan,
different
yeah.
snap scans, etc. So I think it's a good business. I think it's a good management. I think they need the environment to grow, because the economy is not really growing, and you need the financial payments collective to grow, into which they will grow with it. So yeah, I mean, again, with these small caps, you are taking a slightly higher risk, but I do think, from what I know of it, it is a good business, and it is cheap. But most small caps are cheap. The
Yeah.
best thing you can do is to buy the best small caps that are cheap, and avoid those value traps that are also abound in the market.
Yeah, it really, I'm looking at the chart for the past 3 months, and we've had some wild swings. Even today it's down 4%, but I guess you could credit that to the fact that it is a small cap, so liquidity, yeah, is not a lot.
Yeah.
Yeah.
Liquidity is not even good in the mid caps at the moment.
Yeah.
You know, market that's struggling for direction. That's not really. We've had a poor market. We're down, and the rest of the world is up. You know, so there's low liquidity in general, and you'll find even worse with the small caps. So a 4 or 5% move doesn't tell you much about the actual
Yeah.
company's performance.
Yeah. Well,
So yeah.
talking about low liquidity, because I mean that's something that we've been dealing with since the start of the year. There's a question here: what effect will the US and local elections have on the global and local stock markets? Does it boil down to liquidity, that people really just want to stick to cash because the environment is so uncertain?
That's a good one. I think it's worth separating the US from South Africa. I think the election outcome risk, certainly economically, is probably a little greater in South Africa than in the US. So if you have an ANC non-majority win, and they align with the EFF, for example, that could have a far more negative perception. You could see a lot more foreign exits, foreign sellers in our market, and it could be a negative reaction. The rand could weaken, etc. So the potential for a negative outcome is greater in SA elections. In the US, there's so many controls and balances in that system that even if you have a new president, he can influence things, but he is also somewhat constrained in how much he can change. And so I suspect the other thing is, I want to say, is it's very difficult to invest for an election. Your job as an investor is to buy good companies that should be able to do well in most environments, regardless of who's running the country, relative to your other investment opportunities. You can't, if you don't know the outcome, you can't invest for it. So rather invest around it, and find a more defensive business, or save some capital for post the election, when you have some clarity, if you're really concerned. And
Yeah.
don't spend too much of your time trying to guess which way the election goes. Unless you're a trader,
Yeah.
then have a go by all means, have your stop loss and all that sort of thing. But as an investor, it's not really a wise
Yeah.
decision. You would
Yeah.
say. Yeah.
As a trader, at least you can take your profits in the short term and the like.
Yeah.
Grant, I don't know if you saw Grinrod shipping today. The share price was up 20%. I've actually been confused about this, because obviously Taylor Maritime came in and said that they're taking the company, they're buying the company, but that's been going on since 2022. And then eventually today, Grinrod Shipping took out an announcement saying that they're going to reduce the share capital. Is that like a buying out of the shareholders that own the rest of the shares that this company does not already own?
So I haven't read this part,
Yeah.
but if they're reducing the share capital,
Yes.
that means whatever share capital remains, the percentage holding of those remaining investors will be greater.
Yeah.
So they might actually be, maybe they hold a lot of treasury shares that they're going to cancel, and that'll upweight everyone else's holding in the company.
Yeah.
That's what it sounds like.
And
I
so,
can't say I'm not close to it.
And so Grinrod Shipping is coming out of the JSE.
Oh, okay. So they're going to take out the whole company.
Yeah.
Okay.
Yeah, no, that's what I'm asking as well, because I know that this deal has been going on since I think 2022. So now the Taylor Maritime Investments will have I think they own about 86% of the share price. So it's been quite an interesting move to watch there with the Grinrod shipping up. I think even yesterday it was up about the same price.
Okay.
Yeah,
There's so much value in these small caps. You
yeah.
know, if you find good businesses, you're getting them at incredibly good prices at the moment.
All right. Well, talking about the news that have come out of the JSE today, Sanlam also announcing that they are increasing their stake in the Shriram insurance business in India. Of course, that has been quite a good market for them. I think really just a good market for everybody at this point. Just what do you make of the direction that Sanlam is going in, and particularly going into that lucrative market of India?
I think it's excellent. We've long liked that asset. It's, you know, financial services, insurance, these kind of businesses are very closely tied to an economy. And India is an economy that's been growing and projected to grow at 6.5 to 7% over the next 10 years. And if you contextualize that, South Africa is growing at 1%. Imagine
Yeah.
sevenfold that number. So it's a phenomenal opportunity. It's a really good business. What I like is that they've been there a long time. They didn't just buy it last year and now they're doubling up kind of thing. They've been invested there for, I think, 10 years now. So they know what's going on. They understand the market. They're buying with knowledge. So I think it's a good move. I like what they're doing. I think it's really a little gem in the portfolio, potentially still undervalued as a component of Sanlam. So I'm encouraged by that.
All right. Well, something else that you are encouraged by, Grant, let's get to your stock pick for today. What are you picking?
Um, so I'm thinking, to be honest, I've said it for a while. I think Sanlam is a very good opportunity. I think they've had a healthy pullback, and the results, they've been delivering strong results in a very difficult market. This market has been tough to operate in. We've seen some of the peers really struggling, and it's a tough economy. It's hardly growing. And if you see an uptick, if you see rates tick down, you see the consumer confidence start to return, and you see commodity prices rally, that will benefit some of the rest of their African operations. India is a standalone pillar of strength, as we've talked about. And then you've got some improving prospects in South Africa as business and consumer confidence improves, assuming the election goes our way.
Yeah.
So I think it's a lovely play. I think it's a nice opportunity, and it's one you can sleep at night holding this company.
All right. Well, thank you so much for your time and for your insights and analysis today, Grant. Really appreciate it. That was Grant Nader from Benguela Global Fund Managers.